Ajay, how are you feeling about the markets in a bit of a snooze mode? You know, we've been talking about how we were anticipating a price correction or a time correction. We got a little bit of a price correction, but the markets have now moved into a no man's land in so many ways. Do you feel like this is the right in between of a slow grinding correction that may continue for the next couple of months for the markets?
Seasonally, December is quite good. Over the last 20 years, about 14 times Nifty has ended positive and 13 times the Sensex in the last 20 years. So seasonality is in our favor. Second, given the Indian budget comes on 1st February, we normally do see a pre-budget pickup. What has happened this time around, the spending winter which started in March. And we thought that with the new budget in July, the spending winter will be over and we'll see focused spending by the government. That has not taken off. And Maharashtra, which is 14 to 15% contributor to Indian GDP, we saw a policy logjam in Maharashtra as well because of the election. So a big state of yours loses out about 200 days of spending, and that causes a bit of an issue in the overall economy. We are seeing that. Now, what was needed was that around after the September GDP numbers came out, some counter cyclical measures could have been taken by the RBI on the monetary front and the government on announcing big projects and releasing a lot of funding into the economy. Both have not happened. And RBI instead chose to burn up $50 billion of FX reserves in protecting the rupee. That became counter-cyclical. When the Chinese were depreciating, there was competitive depreciation happening in Southeast Asian currencies, in the Mexican peso. In all your competitors were going in for either involuntary or voluntary depreciation. Indian central bank chose to protect the rupee. And yesterday you have seen the result of that, the $37 billion trade gap that has come out. So you have bad liquidity in the banking system, very tight liquidity. You have a rupee which is stronger than its natural level, and you have a lack of fiscal or monetary impulses. That is the drawback for these markets. We are hoping that with the February RBI policy, some of that will be addressed. And with the budget coming up, there will be some amount of buying in anticipation of the budget. That's what will take these markets up. So slow grinding otherwise, but with some policy impulses coming in, you could see the markets pick up again.
Mr. Bagga, good morning, Neeraj. It's been a while that we've spoken. I hope you're doing well, sir. But just trying to understand, I heard you speak about Maharashtra elections, lost, etc. But now that the government is back, and it's not a coalition government per se, do you believe the spend on infra from a state as large as Maharashtra could actually get some of the infra companies' order books revved up? And could that help the stock market fortunes for some of these companies?
I think so. Neeraj, it's very difficult to spend 11 lakh crores on infrastructure year after year. You went up from 4.5 to 6 to 8 to 10. And it was a big ask because last year also nearly 50,000 crores went unspent. And then we had this very prolonged, 9-phase national elections, and post that a surprising result for the markets, and that took some time. And then you had some big state elections coming up as well. So we have lost this year to a large extent. Consumption was in trouble with cumulative inflation of the last 4 years. The food basket has become very large. And if you see the average Indian, you take India as a whole, and that's a large block of Indians, maybe 60-70% of Indians are spending about 6,500 per day if you're in urban India, 4,500 per day if you're in rural India. And most of it, nearly 54% of that is food items. And then if you have food inflation running at 9-10% year on year, you can understand where that basket has gone. Wages have not kept up with that. So there has not been a huge injection of employment in the economy. So if out of the four pillars, only the government infrastructure pillar is working, government capex is working, and on the revenue side, government spends. Private capex was still not catching up. Companies were in a deleveraging mode. The banks were in a cleanup mode. So you look at what has happened over the last 5 years, the sharp fall in the COVID masked this. What was already coming in 2019, those trends got masked, and we thought there's a huge growth coming into this economy thanks to the COVID fall and the recovery from there. Now that we have stabilized post-COVID, now we are seeing the struggle to get over that double-digit nominal GDP growth. We need 12 to 14% kind of growth to really, get to that 2047 number. And for that, you need counter-cyclical boosters from the government and the RBI whenever the economy starts getting into a stall kind of a mode. Now, again, this is not stagflation or anything. This is not negative growth. Still, you're growing at 5%, and you have an inflation of 4 to 5%. So you're pretty much in double-digit nominal growth. But it is stalling in a lot of sectors because of the K-shape after the COVID. Second, if the government doesn't spend, your exports are poor, the government doesn't spend, you're in deep trouble, which is what is happening right now. So hopefully over the next 4 months, we will see some catch up. Or now it's down to 3.5 months, and more or less till Jan 15th, not much will happen. But I am positive that the budget will bring in much more. Now the government has a 4-year highway to bring in reforms that it wants to. Reforms might not come, but spending will come. And the RBI, I'm sure, will do some course correction. It was not a well thought out move to keep protecting the rupee when the Chinese are depreciating. And when you know the 2018 scenario, when Trump first put in tariffs, the Chinese reaction was to depreciate the renminbi. And we can't stand in a vacuum and say, no, a weaker rupee will bring in imported inflation. All those are measures. But you can't also artificially inflate the rupee. Our exporters are not competitive. And given the interest rate, levels in India, the Chinese are borrowing 10-year, their 10-year yields have gone below Japan's. So, they're borrowing so cheap and you are borrowing so expensive. You can't equate the two. Your way out is to have a depreciating rupee, whatever the other consequences. And second, you need to let the liquidity be in the banking system. If you grab that out, you take that out, that's a very restrictive monetary policy at a time when the economy is slowing down. So that's what's happened, and we have seen the results in the stock markets.
Yeah.
Now, seasonally, Neeraj, expecting a pre-budget rally. So the usual suspects like railways, defense, PSUs,
Okay.
capital goods will rally going into first
Okay.
wave.
Ajay, we were having a discussion with Sandeep some time ago this morning to understand what is in store for the IT sector. Numbers were nothing great, but of course the story was that there is the election overhang on these tech companies, and post-Trump's victory, these stocks are up 35–40%. Now, is there any merit in buying into the IT pack, making portfolio allocations towards the IT sector? Do you feel like earnings will also reflect the same euphoria that the stock prices have had?
Not yet. I think earnings will be as per the management guidances, which were quite conservative, but the market is discounting the future. What is happening is nearly 1/4 companies in the world are now talking about using some form of AI. Nearly 50% employees have started using the publicly available AI platforms. So these end use cases that our companies are taking out, those will gain traction. If you look at some of the big US services companies' results, people were not really giving them, bidding up the stocks based on the 9% overall revenue growth. But if a company had 25, 30% growth in the cloud business, if they had a 30% growth in the AI business, those were the factors that were really going into the pricing of the stock. So that's what's happening. It's a time of churn for our IT companies, something like Y2K, when really they came into their own when the 2000 date was changing and Indian IT came into its own. This AI format, the cloud format, the entire automation, digitalization, it's such a huge revolution coming up that nobody's got the business models yet. There will be a lot less people, but there'll be a lot more work and much faster work, more productivity unleashed for clients. Those are the big trends that are happening, and our companies have worked over the last 2 years in upgrading themselves towards that. So I would still buy, even though this year has been a outperformer year for IT. Only banking and FMCG to some extent are really disappointed. But overall, if you look at the calendar year, real estate, capital goods, IT, pharma, they've really, or even automobile, which has been out of favor for the last 2, 3 months, has done very well on a calendar year basis. So I would still buy in IT more on the hope rally, but don't hope too much from the results yet. I think that's still about 4 quarters away when we start seeing this traction coming up, and the market is okay with that. That at least the right moves are being made by the Indian IT companies.
Mr. Bagga, before we wrap up this conversation, a 1-minute answer, sir. You've given us a seasonal factor, but in 1 minute, if you can tell us, when you think of 1 year or 2 years out, what is your best bet? What theme is your best bet? We have a minute, Mr. Bagga.
That's a tough one. India
I'm
is
giving
my
you 2
theme.
years, sir.
Yeah. I think banks, I would say banks, you're going to see a lot of growth in financials. So, and it's domestic and the cycle works for them. Once the rate cuts come in, it will go up a bit, then it starts plateauing, but a lot of trends. And so if India is your trend, then consumption and, domestic cyclicals become your biggest bet because we don't know how Trump will go. And in fact, I would say that 2025 outlooks, Neeraj, will change by the middle of February when we have seen Jan 20th Trump, the first executive orders coming in, and then what happens on policy. Because a lot of Trump is posturing, a lot of Trump is opportunism, and rather than on the ground. So a lot of the moves that have been made by the markets might be, proved to be wrong by the actual Trump. So I think our outlook will change in a global sense. But on India, you're well positioned if you stay with the domestic cyclicals, which don't depend on the global economy. Global economy has gone gangbusters after COVID. Catch-up is coming. How good is the Chinese stimulus? How well does Trump prove to be for unleashing animal spirits in the US economy? Those are big question marks, but India is a tick mark. So I would go with India and within India financials.